Welcome to the weekly market update. I'm the options overlord, and this is the market week ending Friday, August the 7th, 2026. Educate, discipline, execute. Let us get into it. First, the ground rules. Every week, no exceptions. This is educational content only. It is not financial advice, and it is not personalized to you. Options carry real risk and are not suitable for everyone. Nothing here is a recommendation to buy or sell any security. There may be tax implications to any strategy, so speak with a licensed professional about your own situation. Everything I show you is a framework for thinking, not a signal to trade. Accountability first. Every week, this channel sets a rule for the week ahead, and every week we come back and grade it in public. Last week, the rule was watch VIX above 20 with breadth below 55. Both conditions together would have marked a return to concentrated market stress. The verdict held. VIX finished at 14.90 below 20, while breadth stayed broad at 65.6%. Neither stress condition triggered, so the rule held. The scoreboard. The S&P 500 closed at 7,757.64, up 3.58% on the week. The QQQ closed at 723.03, up 5.09%. The Dow closed at 54,036.93, up 2.96%. The VIX finished at 14.90, down 1.09 points. The 10-year Treasury yield finished at 4.65%, down 10 basis points, and breadth finished at 65.6% above the 50-day moving average. So, options priced a weekly swing of about 2.07%, while the S&P actually moved 3.58%. Realized movement exceeded the implied weekly move. The regime map. One picture, four boxes. Where are we? This week, participation broad, index volatility compressed. Breadth is 65.6%, while IV rank sits at 13.6 for SPY, 39.1 for the QQQs, and 5.8 for IWM. Translation: participation stayed broad, but the market was not paying much for broad index fear. The QQQ remained the richest of the three volatility proxies. The premium read, where the market is actually charging for risk. The QQQ IV rank is 39.1, still the highest of the three. SPY's 13.6 and IWM is just 5.8, meaning technology-linked premium still carried the richest relative pricing, but volatility compressed as stocks rallied. A higher IV rank is not free money, and a lower IV rank does not make a trade safe. Selection, price, structure, and risk still matter. If you want the free checklist I used before selling a covered call, the covered call qualifier is linked below. What actually mattered this week? The lead was the July jobs report. Payrolls unexpectedly fell by 23,000. Treasury yields moved lower, and expectations for the rate path shifted quickly. The S&P 500 finished the week at a record close. The weekly market moves confirm the strength. The Nasdaq Composite gained 5.19%. The S&P 500 gained 3.58%. The Russell 2000 gained about 3.5%, and the Dow gained 2.96%. WTI moved the other way, finishing down 7.7% for the week. On rates, the 10-year finished at 4.65%, down 10 basis points, and the 2-year at 4.19%, down 9 basis points. The takeaway: weaker jobs pulled yields lower. Indexes rallied while WTI still fell 7.7% for the week. Risk watch: the VIX reads 14.90, low to moderate, but next week is not a low event risk week. CPI arrives Wednesday, August the 12th at 8:30 a.m. Eastern. PPI follows Thursday at 8:30 a.m. Eastern, and retail sales is due Friday at 8:30 a.m. Eastern. On earnings, these are event risk examples, not trade recommendations. CoreWeave on August the 11th with an implied move around 13%. Cisco on August the 12th around 11%. And Applied Materials on August the 13th around 18%. The discipline: a low headline VIX does not remove event risk when inflation data and major technology earnings are stacked into the same week. The Overlord Read: broad participation, lower yields, stronger indexes. The divergence: the QQQ IV Rank remained highest at 39.1, even as the VIX fell to 14.90 and breadth strengthened to 65.6%. Why it matters: the rally broadened while option pricing compressed, but technology-linked premium still remained richer than SPY and IWM. Put simply, the market was calm at the index level, but the relative price of risk was still not evenly distributed. So here is the rule for next week. Set now, graded next Friday. Watch the VIX above 20. If breadth slips below 60. Watch level VIX-20. Both conditions together would challenge this week's broad risk-on regime and signal that participation is weakening while volatility is rising. That is the line in the sand, and we will score it in public next week, held or broke with the reason. The free covered call qualifier is linked below. Thank you for watching. Stay disciplined. Let us go.